Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. It's the end of the week, so let's try to keep the episode relatively short. There are several important updates that we need to cover, however, and let's begin with an update to an ongoing story. Yesterday, I put up a special episode after the World Health Organization asked China for more information about clusters of undiagnosed pneumonia in children in North China. It's still unclear what the situation is and whether it is serious or not. At the very least, it is unusual. What is clear is that Beijing and other parts of China are battling a surge in respiratory infections, mostly affecting children, and some hospitals are past full capacity. Chinese financial media outlet Caixin writes today, for example, quote, hospitals in parts of China, including Beijing, Shanghai, Wuhan, and Guangzhou, have recorded a surge in mycoplasma pneumonia infections over the past few months. In the capital in particular, some children's hospitals and pediatric departments are close to capacity, if not already full, due to the surge. End quote. Mycoplasma pneumonia is an atypical bacterium that is commonly found in children and can lead to life-threatening conditions such as severe pneumonia. On Thursday, China's National Health Commission said it was, quote, paying close attention, end quote, to the overcrowding situation and recommended that patients with milder symptoms go to general hospitals and clinics instead. Beijing's official explanation for what is happening, according to the National Health Commission, is 1. The surge in these infections could be attributed to 3 years of COVID controls that have led to weakened immunity. Some international experts agree that this explanation could be accurate. Quote, their lengthy lockdown must have drastically reduced the circulation of respiratory bugs. Unless new evidence emerges, there is no reason to suspect the emergence of a novel pathogen. End quote. 2. These epidemics are cyclical, occurring every 3 to 7 years. And 3. Case numbers are still relatively low. However, we note that Beijing has not revealed the official number of cases, and anecdotal cases are not promising either. Quote, 90% of the hospital's 300 beds are occupied, and long lines have formed outside our already overburdened hospital. Doctors have been working overtime, and all medical resources have been used to meet patient demand, but it still may not be enough. This year has been the worst year ever, at least as far as I know, for mycoplasma infections. End quote. In its latest statement from yesterday evening, the World Health Organization said that, quote, Chinese health authorities have not detected any unusual or novel pathogens and provided the requested data on an increase in respiratory illnesses and reported clusters of pneumonia in children. End quote. However, with memories of the opening months of the COVID pandemic still very fresh in many minds, there will be some in the international community who will be hesitant to believe reports from Chinese health authorities. It's still very early, however, and experts are advising calm. Quote, what we are seeing is WHO's international health regulations system in action. I am not going to push the pandemic panic button on the basis of what we know so far, but I will be very keen to see the response to WHO from China and see the WHO's assessment following that. End quote. Let us hope that there is nothing to worry about, but we will continue to follow the situation as it develops. Next up, let's quickly move through several notable developments related to the economy. If I could ask a favor of regular viewers of China Update, about 50% of regular viewers are not subscribed. Subscribing to the channel is a big help, as does hitting the like button. It does help the channel grow, which means eventually I can transition to doing this as a full-time job, meaning higher quality and more content. So if you do get some value from this sort of content, and for those who can go the extra mile and help me keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much everybody for the ongoing support. This week, shares of Chinese property developers continue to climb from low bases amid signs that regulators will soon roll out bailouts and other measures to rescue builders, partly to ensure tens of millions of apartments can be finished. We've been following this closely this week. Property stocks extended their rally for a fourth day on Thursday, with a wind info gauge of property stocks climbing 2.14%. Hong Kong traded property stocks, mostly made up of developers, jumped 3.31% on Thursday trading, all following reports that the top financial regulator in Beijing ordered financial institutions to meet the reasonable funding needs of property developers. More than 40 property stocks jumped over 10%, including massive Country Garden Holdings, which saw a 23.5% rise. Chinese financial media outlet Caixin writes, quote, Chinese regulators have made repeated calls to support the real estate sector as an industry-wide liquidity crisis has stretched for more than 3 years. End quote. In the latest effort to rescue market confidence, it explains, top regulators told banks to keep their real estate loan growth at a level no lower than the banking sector's average real estate loan growth. We covered this earlier this week. An executive at a state-owned large bank told Caixin that he has heard of the list and his bank is waiting for the central bank to send out the final list. But some banks have already started loan pitches to key developers. The piece continues, quote, China's real estate industry has been struggling and contracted 2.7% in the third quarter, the biggest drop this year. Home prices declined the most in 8 years in October, and funding for property development dropped 13.8% on year in the first 10 months of 2023. The persistent downturn has spooked investors, pushing Chinese developers' dollar-denominated bonds to plunge 87% over the past 2 years. The rout has wiped out $135.5 billion of value from $154.8 billion of outstanding notes. End quote. Next up, while developers are having their week in the sun, China's embattled investment conglomerate Zhongzhi Investment Group is not so fortunate. In a letter to investors published on Wednesday this week, the conglomerate disclosed a financial shortfall of 260 billion yuan, $36.5 billion, and warned it was severely insolvent. We remember back in June, Zhongzhi entered the news after several of its wealth management and trust business affiliates failed to repay investors. Zhongzhi is one of China's largest private wealth managers. In a Wednesday letter, the company expressed, quote, preliminary due diligence shows the group has endured a significant risk of sustainable business operation, and the company doesn't have sufficient assets to cover debt in the short term. End quote. Next up, and finally for today, despite these pressures, or perhaps because of them, Chinese government advisors are recommending economic growth targets for next year ranging from 4.5% to 5.5%. In an exclusive report, UK-based Reuters, speaking to several advisors who attended a recent annual policymaking meeting, reports that the proposed growth rate, which would likely be much higher than real underlying growth, thus necessitating debt-fueled fiscal intervention, will be made next month at the party's annual Central Economic Work Conference. The Central Economic Work Conference is an important event to follow closely as it discusses policy plans and the outlook for the economy in 2024. Outspoken pro-expansionary fiscal policy advocate and government economist Yu Yongding told the outlet, quote, we need to adopt expansionary fiscal and monetary policy to stimulate aggregate demand. Corporate investment demand will not be strong as the confidence of companies has not recovered, so we need to expand infrastructure investment, end quote, adding that he supports a budget deficit of over 4% this year after the October announcement of another 1 trillion yuan, $139 billion in sovereign bonds. The 2023 budget deficit rose to a record 3.8% of GDP from the original 3%. It's worth taking a step back and reminding ourselves that this first post-zero COVID year was supposed to be strong without the need of any fiscal deficit. This evidently didn't materialize. Another unnamed advisor reportedly told the outlet, quote, we are stepping up fiscal policy support to make the difficult 2024 target achievable, end quote. Again, making it clear that these growth rates are only obtainable through government borrowing, even as total debt in the system continues to surge. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Friday, and I will see you all tomorrow.